Governments constantly spend more money than they collect from taxes every year. So where does the extra money actually come from in the first place? Most people think governments simply print endless money whenever they want. But modern systems are quieter, more complicated, and far more powerful than that. The process usually begins when governments spend beyond their available tax revenue. That gap between income and spending is called a budget deficit. To cover that deficit, governments issue enormous amounts of bonds to investors. Investors lend money today in exchange for future repayment with interest attached. But eventually, buyers stop lending unless interest rates become increasingly attractive. This is where central banks quietly enter the picture behind the scenes. Central banks can create new digital money with nothing physically printed at all. They use that newly created money to purchase government bonds from financial markets, which quietly injects fresh liquidity into the entire banking and economic system. The government receives funding while interest rates remain artificially lower than expected. The system survives because confidence keeps people believing the currency still holds value. But if too much money enters the system, inflation begins quietly accelerating everywhere. Prices rise first, then purchasing power slowly disappears from ordinary workers and savers. Governments rarely run out of money first. Citizens usually feel the consequences earlier.